Welcome back. I'm Jeremy Safran, and we're coming to you on what is shaping up to be a pivotal Friday in the markets. Now, moments ago, we just got the September CPI report, which was delayed due to the ongoing U.S. government shutdown. Now, according to the BLS, the Bureau of Labor Statistics, headline inflation came in cooler than expected, rising 3% year over year. Now, the market's reaction was quite immediate here. The S&P 500 hit a new all-time high, and gold continue to spike as traders now fully price in a Federal Reserve rate cut for next week. But this morning's optimism comes at the end of a brutal whiplash week for investors. On Tuesday, gold, as we just showed, suffered its worst single-day crash in over a decade with 6% intraday swing that erased months of gains in just a matter of hours. It's since stabilized there past $4,100 on the spot side. And this is happening against a deeply conflicting macro backdrop. The IMF just released its World Economic Outlook, calling global prospects, quote, dim and projecting slowing growth into 2026. And at the same time, the stock market seems to be telling a very different story. Now, we're in the middle of a strong Q3 earnings season, but valuations, particularly in tech, are at levels not seen since the dot-com bubble, leading major banks and even the IMF to warn of a potential market correction. So what do we do here? How do we navigate this? A slowing global economy, extreme volatility, and a potential bubbly stock market. Is this time for safety? Is it time for speculation? To help us make sense of it all, we're joined by a true architect of modern investing. He was there for the rise of ETFs at iShares. He led the sponsor of the world's largest gold ETF, and today he is the founder of and the CEO of GraniteShares. Now, that's a firm that has amassed over $11 billion in assets by creating the very tools investors are now demanding. Will, welcome back to the show. Good to see you.
Good to see you too, Jeremy. Thank you so much for having me.
11 billion, huh? You've seen some inflows this cycle. I want to talk to you because speaking of cycles, I mean, you've been in the industry through multiple cycles. Does this combination of slowing growth, some sticky inflation and this extreme volatility signal a structural shift in the market and a new regime that investors need to prepare for? What are your thoughts on this market?
I actually am pretty positive about the market in terms of where we are today. I think what you're seeing in the stock prices, at least, is the positive news that we saw today on inflation, but more broadly, giving the Fed that room to cut interest rates, to ease financial conditions that will, help stock market earnings and prices going forward from here, certainly to the end of the year.
Mm-hmm. Yeah. We're going to get into some of those returns because, I mean, they've been incredible. I mean, the S&P is still kicking it today. But you've said, when we talk about gold, I mean, you've said before that gold's rise isn't about it becoming more valuable, but about paper currencies falling. Obviously, we got that debasement trade. We're seeing it now. Reports of central banks obviously holding more gold than U.S. Treasuries for the first time since 1996. Is this debasement trade accelerating? I mean, what are you seeing in your own fund flows? Are investors actively moving into hard assets like your gold ETF? BAR is kind of a direct response to this?
They are, in short. And, we've seen this year probably the best example of where the dollar's fallen year to date against other currencies. And in many ways, the Federal Reserve and the U.S. economy has been an outlier in terms of interest rates versus the rest of the developed world. With a few exceptions. But with the interest rates coming down, and again, today's inflation data, giving the Fed that room, I think, to continue to cut, that interest rate differential between the US and the rest of the developed world starts to shrink. And therefore, the premium, if you want to call it that, on US dollars shrinks also with that, the relative attractiveness of the high yielding dollar versus other currencies. So I think we expect the dollar to weaken further. And obviously that, in the historical context has always been good for gold.
Mm-hmm. Yeah. And we've seen, obviously we get that latest print today, a little bit less than expected, which is always positive. Of course, the Fed possibly cutting. But a lot of investors have been worried about stagflation. I mean, JP Morgan has called gold that ultimate hedge for this exact risk. As a product creator, I mean, how do you think about building a portfolio that's resilient to stagflation, an environment where both traditional and stocks, maybe some bonds could get hurt?
Yeah, I mean, I think in essence, Jeremy, this is really what we do in a nutshell, which is our job to build portfolios, build investment strategies for all market conditions, regardless of whether we're in a high growth environment, a low growth environment, high inflationary environment, low inflationary environment, and everything in between. So we always hope to have something in our portfolio that we can offer investors that will perform, in any market conditions, whether it be stagflation or whether it be, normal market conditions.
I got to ask you about the commodity complex. I mean, it's been fascinating to watch throughout the entire years. Obviously, we're seeing some of those earnings coming too as well. And then we layer on top this geopolitical risk. I mean, the list of hotspots is growing, from these trade tariffs to active conflicts, creating some pretty big risks for the supply chain market. How does this fracturing kind of global order change the calculus for commodity investing for, say, the next 5 years? What are your thoughts on that macro front?
Well, I think that we really have to sort of talk about commodity investing in two camps at the moment, which is hard assets and everything else. Hard assets, and particularly metals, have performed very well this year. And that's really been the trade of this year from a commodity perspective. You've got gold outperforming stocks, quite significantly. And then you have silver, platinum, palladium, other metals that are also joining this party and outperforming. So that is the good news. The perhaps less good news is the other commodities, namely some of the energy products, the oil, etc., hasn't performed that well. And that's largely because of the concerns about the global economic growth and perhaps the economy slowing down and the demand not being as robust as you might expect.
Yeah. I'll ask you about oil, because it's been fascinating just watching some of these new tariffs come into play and what that means. It feels like crude is just taking a little bit of a breather here. But, we talked about it briefly there, Will, on this stock market environment, right? I mean, the macro uncertainty is creating a fascinating disconnect because corporate earnings are surprisingly strong, yet valuations are at levels that many, including the IMF and some major bank CEOs, are warning about that potential bubble, as you've heard, right, particularly in AI. And I mean, the S&P's forward PE ratio is now rivaling the peak of the dot-com bubble. As someone who was at iShares during the first tech bubble, I mean, does the current AI boom feel like a durable revolution or a speculative mania that could end badly? You seem to think we're in a good shape here.
I think sort of all of it can be true, and that's the interesting part about whenever you go through phases like this. And the late 90s, the dot-com bubble was no exception, in that there were huge amounts of money made in that time, huge amounts of money lost. There was a huge amount of money that was burnt in terms of capital expenditure on building what we now obviously know as the internet. But the results of that were clearly the content companies, just for one, that everybody knows and loves today, and the Mag 7 players, which are largely created out of the back of that. So I think that today is no different. We're talking about AI in the context of being the fourth industrial revolution. And I think your starting place is you have to obviously come to a conclusion whether you're a believer in the AI story or not. There is absolutely no doubt, everybody can see it, that there are hundreds of billions of dollars being spent on building the AI infrastructure of the future. Not everybody will be a winner. Not everybody is going to come out smelling like roses in this. And there's no doubt that this will create winners and losers just like it did before. But I think everybody that's in this game right now is of the belief that the opportunity is too big to stand on the sidelines. And therefore, people must invest. They must try and build to take advantage of this potentially once in a generation opportunity. But of course, within that, there is a cautionary piece of information, just like there always is, which is, again, this is not going to be something that benefits everybody uniformly.
Yeah, and this AI build out will obviously require a biblical amount of power and raw materials like copper. Data centers are driving a massive capital expenditure cycle. Is the most durable? I mean, outside of that, we can take the risk on the S&P and some of those Mag 7, but what about the picks and shovels? I mean, is that a way to invest in this revolution, not through the tech stocks themselves, but through the commodities that physically power it?
Yeah, I mean, there are different ways of looking at what that actually means, because I think this standout company within the space is NVIDIA, which people would point to as being the manufacturer of the picks and shovels, so to speak, for the AI industry. People now also talking about Tesla in the same way, that in terms of physical AI, that the two leading companies out there are arguably NVIDIA and Tesla. Tesla obviously being the company that will hopefully deliver the autonomous vehicles and potentially robots that people talk about so much with, or synonymously with, AI. But you're absolutely right. There's also the power. Where does this power come from that will power the AI data centers, the hyperscalers, etc.? That power has to come from somewhere. And that's why there's a race you've seen with nuclear stocks, with all sorts of energy providers, all the way through the ecosystem. And again, massive wranglings between the US and China over the provision of rare earth minerals, which are, critical for the production of some of these new technologies. So this is something that really is not just about Mag 7 tech companies, that the ecosystem around AI extends way further and way beyond that to traditional power players, as well as utility companies and other perhaps less sexy and well-known parts of the industry.
Yeah, well said. And I mean, it brings up the core risk too. I mean, the rise of passive investing has fueled the growth of these mega cap firms, creating that kind of feedback loop where the weight on the index just continues to get bigger. No, I mean, the top 10 stocks now make up a record 39% of the S&P 500. What does that concentration do in terms of risk? I mean, if any bubble pops there, I mean, what happens to the millions of investors in simple index funds?
Well, their prospective shares of that index would go down just like anybody else, because the index is the market is the index, whichever way you want to look at it. I think one thing I would say, or would point out just regarding the valuations, that yes, the valuations are high, and you can look at the context of today's valuations with, for example, the late 90s, etc. But I would point out that the companies today are a lot higher quality than they were in the late 90s. So while people can look at just numbers in a vacuum and say, the PE is this and that, and it's analogous with it. Yes, but looking beyond just the raw numbers, the quality of the companies is just very, very different. So you could argue just right there that where we are today does deserve a premium in terms of the market, because the companies are just not the same as the pets.coms and things of the past. That these are massive corporations that have proved themselves in many cases over a decade. I mean, clearly you go back to Microsoft, Amazon. These were companies that were here in the late 90s and have not just survived to tell the tale, but have thrived and gone on to be some of the largest companies in the world.
Yeah, some of them continuing to just, beat expectations. I mean, what are your thoughts on investors being more selective kind of in this market? I mean, your career tells a story about evolution. You helped build the passive revolution, but now you're also creating these highly active kind of tactical tools for what you call the high conviction investor. Is the era of, simple passive buy and hold investing over?
I don't think it's over, but it's definitely evolving, Jeremy. I think what we're seeing is with the advancements in technology, that this extends to not just the companies that we know and love, but it extends to areas of the market that we exist in, for example. And so with the advancements of technology, we're able to bring new products to market, which were not possible a few years ago. And that means new types of investment strategies. And so we're seeing an evolution where the market is going to more precise investment exposures that meet people's specific needs. So perhaps put simply, we're producing the tools that investors can use for very specific jobs, as opposed to maybe going to generic solutions as they might have done in the past. So whether that's specific leverage solutions, whether it's income solutions, whether it's commodity solutions, that now you can find something very specific that fulfills your investment objectives in whatever market environment.
What does that look like? I mean, is it dividend investing? I mean, you talked about a shift in retail behavior, kind of a move towards what you're calling financial independence, where people want to generate active income streams. Is that what's fueling the explosive demand for your leveraged ETFs, which have seen billions in inflows?
Yes, in part. So what we're talking about and what we're seeing, I think, is the biggest trend in investing, certainly today, and I think over the next, 10, 20 years at least, is more and more of the market going self-directed. And so you can call it the empowerment of the retail investor, you can call it self-directed. But one thing we know to be true is that the size or the share of retail or self-directed investing in the market is getting bigger and bigger. And that's a combination of advancement in technologies, again, allowing better, easier access to markets. That's more wealth being created that allows investors to participate in markets. And that's a higher level of education that is enabling investors and giving them the confidence to start investing in the market earlier and earlier. And the confluence of all of those factors means that you've got a larger investing population going self-directed, and within that have different investment needs, whether, like you said, whether that's high income, whether it's outsized risk profiles, whether it's more conservative investing. It's really dependent on the end investor, but we're seeing more investors doing it and doing it from a younger age.
Yeah, it's been fascinating to watch. And of course, there's those leverage plays too. I mean, where does the responsibility begin and end? Should there be stricter suitability screens for someone that can trade 2 times, or kind of these option-linked ETFs?
I mean, there are for brokers. I mean, that's really, at the end of the day, it comes down to the broker and the suitability of the customer to buy any investment. Mm-hmm. However, we live in a market where, we are a free market. We give investors access to investments. And ultimately, whether it's the broker, whether it's the investor, it's up to them to decide what investment objective they have and whether these are the right tools to fulfill that, and whether that's leverage, ETFs, or investments, whether it's options, whether it's other forms of derivatives. That's the market that we live in, and depending on your investment objective, these tools may or may not be the right fit for you.
Yeah, I got to ask you about investor behavior, because it seems to differ globally. I mean, you're in the U.S., Europe, and Asia, I believe, right? Well, I mean, you've said
Yes.
that there's a greater appetite for risk in Asia compared to the nanny state mentality in Europe. How do those cultural differences kind of shape the products you create? And what do you see as the future of global investing then?
Yeah, I mean, I think it's always dangerous perhaps to overgeneralize,
Yeah.
but my observation has been that in markets where you have strong economic growth, where the demographics are in your favor, i.e. skew towards a younger population, and you have upward mobility, those are the markets where we see the most activity from an investment perspective. And those are vibrant, retail markets, which are typically enabled by, the regulatory structure as well. Now, to oversimplify, we see that in North America, we see that in Asian countries, but less so in Europe. And I think that is just a difference sometimes in culture, sometimes in terms of where the economies are, that, people perhaps have less money to spend, are perhaps more risk averse, and that translates through to the investment fabric.
I wanted to ask you, I mean, it's kind of funny. I mean, we established a bit of a playbook for that more active, selective kind of investing, but I wanted to ask about these high beta plays for the audience, because usually we think of mining stocks, right? I mean, at least for this audience, and a major producer like Newmont can report huge cost savings and solid results, yet the stock seems to sell off here. And that's been a reoccurring theme across the mining space this year. Is this simply a buy the dip opportunity? What are your thoughts? Because I know, again, you're kind of the foremost gold experts, but you don't have any, I mean, GraniteShares has no ETFs on the mining side, only physical exposure. Was that a clear, deliberate decision? I mean, what's the structural flaw here on those equities?
I don't think it's necessarily a flaw with the companies themselves or the idea of investing in, say, something like gold mining or gold as a proxy through gold mining stocks. Mm-hmm. For us, it wasn't a deliberate decision not to do that. I think it's just something that we have been so active in the physical gold and physical commodity space for so long. That was the first natural move for us. And at least when it comes to gold, the gold companies have tended to underperform gold. But I think part of the reason for that has been that in previous bull cycles, it's always been difficult for the companies to ultimately control costs. In other words, that the costs have been rising, the inflationary pressures on costs have been rising faster than the growth of the companies or the revenues of the companies themselves, and that's always created this sort of disconnect between the price of whatever the mining company is and the price of the commodity itself. And so, that philosophically, that doesn't mean that we are against or not willing to invest or bring products that are involved in underlying mining companies. It's more just an explanation for your direct question around Newmont and perhaps why some gold companies don't seem to participate in the gold price movement as much as gold itself.
Yeah. And I mean, it brings up a crucial point of trust for our audience, right? I mean, you were at the helm of the sponsor for the world's largest gold ETF. In your experience, for physically backed products like your bar or PLTM ETFs, I mean, is the metal really there? I mean, how does an investor get comfortable that the paper they own is fully backed by the physical asset in a vault somewhere?
Great question. So at least when it comes to us, I can tell you that the underlying gold, platinum in our case is really just the two that we have. They're physically backed, and not just physically backed, which means that they have physical bars or platinum ingot in a vault, but they're allocated, which means that they are the property of the trust. That's the ETF vehicle. And that ETF vehicle is owned directly by the shareholders. They're not the property of a bank or a third party. And they're not what we call unallocated, or they're not, in simple terms, able to be lent out into the market, which is the great concern, I think, when it comes to investing in gold from a lot of gold investors. So at least the ETFs that we sponsor, the GraniteShares Bar ETF and Platinum, which is our PLTM, they're physically backed, don't have counterparty or credit risk of a respective custodian, and can't be lent out. And I think the other thing that's worth pointing out is, of course, these are highly regulated financial products. Mm-hmm. They, of course, law, by regulation, have to be regulated, have to go through financial audits, just like any fund. But we go one step further than that and actually have a third-party independent metal inspector come into the vaults 2 times a year and do a audit of the metal that's in the custodian's vault against the records that have been held by the fund, just to make sure that your investors get that sort of ultimate confidence or trust that the actual metal is there. So that's beyond even the statutory financial audits.
Yeah, I want to have a little bit of fun. Look beyond gold, because you just brought up platinum. I mean, you've said in the past that this platinum run could be significant. It's often an overlooked story. I mean, it's an industrial metal with precious metal qualities, and it's still facing supply deficits. I mean, what's the case for your platinum ETF PLTM today?
Yeah, it's a great question, and something that I think we've been big believers in the platinum story for quite some time. Mm-hmm. Just hasn't worked out. And this year maybe is the final time we say that this was the year that platinum broke out. Of course, for everybody watching the show, I think that everyone would be familiar with the fact that once upon a time, platinum used to trade at a premium to gold. That was the gold platinum premium. Platinum was so much known for this that in the English language, we created a word that was synonymous with above gold. In other words, platinum credit card was superior to a gold credit card, etc. Such as this premium sort of baked into law. But of course, platinum ended up trading at a discount to gold, particularly after the financial crisis, and really remained that way ever since. So as we sit today, could $1,600 platinum turn into $4,000 platinum or plus? Then maybe that sounds difficult to comprehend at the moment. But as you said, this is a market that's 30 times rarer than gold. So we're talking about a lot smaller market. It has some of the same properties as gold in terms of being used for jewelry. It's used for investment. And of course, it has a vibrant demand in industry, not just in terms of traditional industries, but also perhaps the industries of the future, talking about the potential for platinum's use in the production of hydrogen, production of green hydrogen, which of course plays a part in the new or the electrification of everything argument.
Is it just a supply and demand story? I mean, we get the constrained South African output, which we know about, the record automotive demand and these tightening inventories. I mean, do you see that gap closing, Will? And what would it take for platinum to reclaim any kind of premium valuation?
I think that's what you're seeing at the moment, Jeremy,
Yeah.
is supply and demand driven because it's a smaller market. But in the same way as it is for gold, the central banks have been, strong bid in the gold market. Now the investors have jumped in, really, helping to move that price. And I think platinum's a similar thing, that you've got the supply and demand imbalance. You have strong demand, but it would take, for platinum to go a lot higher if investors really started to embrace platinum at the moment, then you could see the price going higher.
Okay, well, we can't talk about metals without talking about silver. It's facing a massive multi-year supply deficit. I mean, we've been covering it quite a bit here at Kitco News, and it's driven by that soaring industrial supply. And then, of course, we've had these COMEX inventory losses happening a little bit too. It seems like it's working itself up, but some banks are forecasting prices as high as $65 by 2026. I mean, I know you can't give us a price outlook here, but what's your take on the silver story?
I think so. Similar to platinum, in that it was inconceivable, and maybe people will say that, of course, these things are always easy to say with hindsight, but it was perhaps inconceivable that we were in an environment where we were hitting $4,000 gold, or certainly north of $3,500 gold, and we weren't seeing much of a equivalent move in the likes of silver, in the likes of platinum. Now that's starting to change. And as you rightly said, you've got favorable supply demand conditions in both silver and in platinum. Mm-hmm. But I think, in ordinary market environments, we would have expected this to happen. Price of gold moves up almost always. You're talking about a lockstep movement in the price of silver, albeit with a bit more volatility. So it was perhaps unusual that we were seeing such a rally in gold and not the kind of equivalent response from the silver market. So maybe now it's more of a question of catching up. The gold silver ratio, I think, got to sort of all-time extremes, and now it's more probably a question of silver prices catching up to gold as opposed to anything else.
Yeah. Were you worried there for a minute when we saw this backwardation happening in COMEX? We were hearing about the supply squeeze. I mean, were you worried at all about that?
I mean, perhaps worried is maybe a bit step too far in terms of, I think that, again, these things, whether it be natural supply demand conditions, squeezes in different parts of the market, we've seen tariffs play a role in terms of interrupting flows, and, demand for certain types of flows at different times from by the US and UK, other markets. So it wasn't necessarily a question of worry, but I think it just exacerbates an already stretched situation when you're talking about some of these markets where they are undersupplied, and small demand distortions can have an outsized impact on the underlying market.
Mm-hmm. Yeah, I want to ask you, we could get to that frontier when we talk about alternatives to fiat currency and that debasement trade. We got to talk about Bitcoin as well. How do you view the relationship between gold and Bitcoin in a portfolio today? Obviously it's a touchy subject. We know that they're different, but are they competitors? Do they serve different roles? What are your clients telling you?
I think now we have to view them as competitors in the sense that they're competing for investment capital. Mm-hmm. And one can choose to invest in gold, invest in Bitcoin, or do both. But I think one thing is clear, that there is now demand, and I think the Bitcoin story has actually helped the story for gold, and vice versa. But with people being concerned about markets at all-time highs, concerned about the level of government debt around the world, concerned about inflation more or less still being a little bit more stubborn than perhaps central banks would like, that this demand for alternatives to traditional assets is something that is very much in demand. I don't think is going away. So clearly gold has always played a part in that story for hundreds or thousands of years, as we know. Mm-hmm. But Bitcoin, I think, is also playing a role in that now.
Yeah, I'm so curious. Why do we see capital flow out of crypto and into gold every time this risk spikes like we saw the last time? Obviously just central bank.
Yeah, look, I think when it comes to risk, my personal view, and I don't think this is necessarily a unique view by any means, but to me, Bitcoin is firmly, and cryptocurrencies more broadly, are firmly risk-on assets at this stage. And so therefore, they're much more speculative, much more volatile than gold. So the thread that joins them together is a view or a demand for something that is not traditional assets, something that is independent from the traditional financial systems. But in terms of how they react, they are different assets. Of course, gold much more defensive, much less volatile than something like Bitcoin or broadly cryptocurrencies.
Yeah, well said. Okay, well, let's end with this. I mean, for an investor and some of our viewers at home who started with the simple promise of kind of passive investing, but now they're faced with this incredibly complex and kind of volatile world. I mean, what's your single most important piece of advice for building a portfolio that can kind of, well, not kind of, but actually survive and thrive in this, in the decade to come?
Well, I think the word today is the same word that it perhaps should have been through all time when it comes to investing, which is diversification, and the importance of having diversified portfolio that has different risks in there, uncorrelated or less correlated risks. So whether that's combination of stocks, bonds, commodities, gold, etc., or other asset classes, I think it's important to diversify. But at the same time, let's also be optimistic. There's never been a better time to be an investor. There's never been, more products available, more investment choices, and more access to education.
Yeah.
You can put a product prospectus into ChatGPT and get a simple explanation of a 500-600 page worth, very heavy legal document. And so there's no excuses really now for people not being able to understand the basic concepts of the investments. And therefore, it's never been easier to tailor a portfolio to whatever your financial goals or objectives are.
Yeah, well said. And do your research. That's what I heard from you. All right, from pioneering the passive revolution, which you really have, to building those tools for this new hyperactive market. Fascinating look at investing. Will Rhind, founder and CEO of GraniteShares. Will, thanks for your time today. Very unique perspective. I mean, 11 billion, man. Keep crushing it.
Thank you, Jeremy. Much appreciated.
Thanks, Will. Appreciate your time. All right, we're going to have more coming up here on Kitco News. Of course, we're watching the markets, and we have some fantastic guests. So hit that subscribe button. Stay tuned. I'm Jeremy Saffer. We'll see you next time.